When you really sit down and look at the history of money, like really dig into every major financial crash that we have seen in the last 100 years or so, you start to notice something. It's kind of spooky, actually. They all follow the same pattern. And I don't mean they just look sort of similar or they rhyme a little bit. No, I'm talking about the exact same pattern. If you look at what happened in 1929, it followed this script perfectly. Then you jump forward to 1987, same thing. The dot-com bust in 2000, it's there. The great financial crisis in 2008, it followed it too. It's this sequence. See? It's a 5-stage sequence. And the thing is, these stages, they show up months, sometimes even years, before the actual collapse happens. Now, here's the kicker. The big guys on Wall Street, they know about this. The folks sitting over at the Federal Reserve, oh, you better believe they know about it. And the people who manage money for the billionaires, the real heavy hitters, they definitely know the score. But you've probably never heard a whisper about it. And there's a reason for that. Because if regular folks like you and me actually understood what to look for, if we knew the signs, we'd pull our money out before the house of cards fell down, instead of getting stuck holding the bag after it crashes. So what I want to do today is I want to walk you through all 5 of these stages. I want to break it down simply so you can see exactly where we are in this sequence right now. And I got to be honest with you, we are a lot further along than you might think. Let's go back in time for a second. Let's talk about 1929. There was this guy named Roger Babson. And one day he stood up at this big business conference to give a speech. He said 9 words, just 9 words. But those words made him pretty much the most hated man on Wall Street at the time. He said, sooner or later, a crash is coming and it may be terrific. And you know what happened? The audience laughed at him. The newspapers, they mocked him, treated him like a joke. Even Irving Fisher, who was like the most celebrated famous economist of that entire era, he came out publicly and dismissed Babson. Fisher famously declared that stocks had reached what he called a permanently high plateau. He thought the good times were never going to end. Well, 47 days later, the market collapsed, and poor Irving Fisher, he lost everything. He died in poverty. But Babson, because he saw it coming, he made a fortune. He even went on to found a college that's still around today. But here's the thing that most people don't get. Babson wasn't just guessing. He wasn't throwing darts at a board. He had developed a real systematic method for looking at financial conditions. He looked at specific things. He looked at credit levels. He looked at how concentrated the market was. He looked at what the big institutions were doing. He looked at liquidity, how much cash is actually moving around. And he looked for what he called trigger vulnerabilities, 5 factors, 5 stages. I actually spent about 3 months recently just going through all the old historical records, looking at Federal Reserve data, reading academic papers, just trying to verify if his framework actually held up across all these different crashes. And it does, every single time. So let me show you what I found. Stage 1 is the credit explosion. This is where it always starts. It doesn't start with greed, exactly. It starts with debt. Before every single major crash in history, there is always this period where credit just expands way faster than the actual economy can handle. It's simple, really. People borrow money that they honestly can't afford to pay back. Then they take that borrowed money and they use it to buy assets, stocks, houses, whatever. When they do that, all that buying pushes prices up. And when prices go up, people feel richer. They look at their accounts and go, wow, I'm doing great. And because they feel wealthy, what do? They borrow even more. It creates this feedback loop that feels like prosperity. It feels like a boom, but it's not. It's actually a trap being set. Think about the late 1920s. Margin debt just exploded. Ordinary Americans, regular folks, were putting down like 10% cash and borrowing the other 90% just to buy stocks. By 1929, the total margin debt was equal to the entire federal budget. You had factory workers leveraged up, like they were hedge funds. Then look at 2007. At that time, it was mortgage debt. The banks created these weird, exotic instruments that let people buy homes with basically no money down. Then they packaged those mortgages into securities and sold them off to pension funds. The leverage was hidden, sure, but it was everywhere. In 2000, during the dot-com bubble, it was corporate debt. You had companies with absolutely no profits borrowing billions of dollars just to expand. They used their own stock as collateral. So when the stock prices fell, the whole structure just imploded. Now, look at where we are today. If you look at the official margin debt numbers, it sits around $750 billion. But I gotta tell you, that number's a lie. It only captures a tiny fraction of the actual leverage in the system. You have to add in securities-based lending, that HIS, where wealthy investors borrow against their portfolios, and that adds another $800 billion right there. Then you add in the leverage that's embedded inside the options markets, where a small amount of money can control massive positions. That adds trillions more in notional exposure. Then add in corporate debt, which has exploded to over $10 trillion. And a lot of that debt, it wasn't used to build factories or businesses. It was used to buy back stock. And don't forget government debt. That has crossed $34 trillion. We are paying interest payments on that debt that are larger than our entire defense budget. If you look at it as a percentage of GDP, the total debt in the American economy right now is higher than it was in 1929. It's higher than 2008. It is higher than at any point in recorded history. So, stage one, it isn't just flashing red, it is absolutely on fire. Stage two is the concentration trap. Here's something they definitely don't teach you in finance class. Crashes don't just happen because prices are high. They happen because risk gets concentrated. When a very small number of assets carry a huge, disproportionate share of the market's value, the whole system becomes fragile. All it takes is for one of those big assets to stumble, and it drags everything else down with it. Back in 1929, the market was dominated by these handful of glamour stocks. Radio Corporation of America, RCA, was the superstar. It went from under $2 to over $500 in just a few years. People didn't understand radio technology at all. They just knew the stock kept going up. RCA made up a huge percentage of the market's value. So when it cracked, the whole market cracked with it. In 2000, it was the dot-coms, Cisco, Intel, Microsoft, just a handful of tech names. The NASDAQ was basically a bet on 10 companies. When those 10 rolled over, trillions in wealth just vanished. In 2008, the concentration was hidden inside the banking sector. 5 banks held the majority of the derivatives exposure. When Lehman went down, it nearly took the whole system with it. Today, the concentration is staring us right in the face, and somehow nobody seems concerned. The top 7 stocks in the S&P 500 now account for over 30% of the entire index. At certain points this year, it's been closer to 35%. Just think about what that means for a second. When you buy an S&P 500 index fund, which is what sits in most 401ks and retirement accounts, you think you're diversified, right? You think you're buying 500 companies. But you're not. You're making a massive leveraged bet on Apple, Microsoft, Google, Amazon, Nvidia, Meta, and Tesla. If those 7 stocks drop 50%, your diversified index fund drops 15 to 20%, even if every other stock stays flat. And here's the scary thing about those 7 stocks. They are all trading at valuations that require perfection. Not just good earnings, perfect earnings. Any disappointment, any slowdown, any crack in the narrative, and the selling will feed on itself. Passive investing has actually made this worse. Every dollar that flows into an index fund automatically buys more of the biggest stocks. It pushes their prices higher, increases their weighting, which means the next dollar buys even more. It is a momentum machine that works beautifully on the way up. But on the way down, it reverses. Every dollar that flows out sells the biggest positions first. Forced selling creates more selling. This is stage 2, the concentration trap. And we are deeper in it than we have ever been. Stage 3 is the smart money exit. Now, this is the stage that makes me the angriest, honestly, because it reveals how the game actually works. Before every major crash, there's this period where institutional investors, the banks, the hedge funds, the family offices, the billionaires, they quietly reduce their exposure. They sell their positions. They raise cash. They buy protection. But here's the thing. They don't announce it. They don't warn anyone. In fact, their public statements often say the exact opposite. They tell you to stay invested. They tell you the fundamentals are strong. They tell you not to panic. And while they are saying that to you, they are heading for the exits. In 1929, the Morgans and the Rockefellers started liquidating in the summer months, way before the October crash. Bernard Baruch, one of the richest men in America at the time, was almost entirely in cash by September. Joseph Kennedy sold everything after his famous conversation with a shoeshine boy. But the real reason he sold was that he had connections to people who knew what was happening inside the banks. Regular Americans kept buying. They were the exit liquidity for the smart money. In 2007, hedge funds started shorting subprime mortgages a full year before the crash. Goldman Sachs famously bet against the same securities they were selling to their clients. Executives at Countrywide and other mortgage lenders were dumping their personal stock while telling investors everything was fine. Regular Americans kept buying houses and bank stocks. They were the exit liquidity. Now, let's look at today. Corporate insider selling has reached levels we haven't seen in decades. CEOs, CFOs, board members, the people who actually know what is happening inside these companies, are selling their stock at a historic pace. The ratio of insider selling to insider buying is at extreme levels. For every insider buying shares of their own company, multiple insiders are selling. Meanwhile, retail investors, regular people like you, have been pouring money into the market. Robinhood accounts, 401k contributions, passive index flows, record amounts. The smart money is selling. The regular people are buying. This is not a coincidence. This is the pattern. This is how it works every single time. Stage 3 is flashing red. Stage 4 is the liquidity illusion. This is the sneakiest stage of them all because everything still looks normal. Prices are stable, maybe even rising. Trading volumes look healthy. Nothing seems wrong. But underneath the surface, the liquidity that supports the market is draining away. Liquidity is like oxygen for financial markets. When there's plenty of it, everything functions smoothly. Buyers and sellers can transact easily. Prices adjust gradually. Shocks get absorbed. But when liquidity disappears, markets stop functioning. Prices don't adjust gradually anymore. They gap down. Small sell orders move prices by huge amounts. Feedback loops take over. The crash feeds on itself. In 1928 and 1929, the Federal Reserve raised interest rates and tightened monetary conditions. They were trying to cool off speculation. But what they actually did was drain the liquidity that was supporting asset prices. For a while, nothing happened. The market even kept rising. People thought the Fed's tightening didn't matter. Then October came. And when the selling started, there was nobody on the other side. The bids just vanished. Stocks didn't decline. They went into free fall because there was literally no liquidity. In 2007 and 2008, the same thing happened. The Fed had been raising rates, credit conditions were tightening, but the stock market stayed high. Housing prices stayed high. Everything seemed fine. Then Bear Stearns collapsed, then Lehman. And suddenly, everyone realized the liquidity was gone. The market dropped 50% in months. Now, look at today. The Federal Reserve has raised interest rates at the fastest pace in 40 years. They've gone from 0 to over 5% in less than 2 years. They've been running quantitative tightening, pulling hundreds of billions of dollars out of the financial system. And yet, the stock market is near all-time highs. People think this means the tightening doesn't matter. They think we've achieved a soft landing. They are wrong. The stress is already showing if you know where to look. In March 2023, 3 major banks failed in a single week. Silicon Valley Bank, Signature Bank, First Republic. These weren't small institutions. They failed because of a liquidity crisis caused by rising rates. The Fed had to step in with emergency lending programs. They essentially printed money to backstop the banking system while claiming they weren't doing a bailout. But those emergency programs, they are temporary patches. They don't fix the underlying problem. They just delay it. The Treasury market, the foundation of the entire global financial system, has been showing signs of stress. There have been moments where liquidity in the Treasury market nearly evaporated. This is supposed to be the most liquid market in the world, and it's having plumbing problems. This is stage 4, the liquidity illusion. Everything looks calm on the surface, but underneath, the oxygen is being sucked out of the room. And that brings us to stage 5, the trigger. This is the one nobody can predict, and honestly, that is exactly what makes it so dangerous. Stage 5 is the event that turns a vulnerable market into a collapsing market. It is the match that lights the fuse. Here is what most people get wrong about triggers. They think the trigger causes the crash. It doesn't. The crash is caused by stages 1 through 4. The debt, the concentration, the smart money exit, the liquidity drain, those create the conditions for collapse. The trigger just determines when. In 1929, the trigger was the Hatry case. Clarence Hatry was a British financier who got arrested for fraud in September. Nobody in America cared. It seemed totally irrelevant. But British banks had exposure to Hatry. They had to raise cash, so they sold their American investments. That selling created more selling. Within weeks, the market was in free fall. A minor British fraud case triggered the Great Depression. Not because the fraud mattered, but because the system was so fragile that any shock would have done it. In 2008, the trigger was Lehman Brothers. But it could have been Bear Stearns, or AIG, or any number of other institutions. The system was primed to explode. Lehman was just the spark. So, what's the trigger going to be this time? I don't know. Nobody knows. That's the nature of triggers. It could be geopolitical, a real escalation in Taiwan, something unexpected in the Middle East, a miscalculation with Russia. It could be financial, a major hedge fund blowing up, a sovereign debt crisis in Europe or Asia, a derivatives accident. And remember, the derivatives market is over $600 trillion in notional value. One major counterparty failure could cascade through the entire system. It could be something in the banking system, more regional banks failing, a run on a major institution, a crisis in commercial real estate that takes down the lenders who financed it. It could be political, a constitutional crisis, a debt ceiling standoff that goes wrong, a loss of confidence in the dollar, or it could be something nobody is talking about. That's usually how it works. The trigger is never the thing everyone is worried about. It's the thing nobody sees coming. But here is what I do know. When stages 1 through 4 are all flashing red, the trigger usually arrives within 12 to 24 months. We've had 4 stages confirmed since late 2024. That puts the window somewhere in 2025 or 2026. Now, let me tell you what this doesn't mean. I'm not telling you the market is going to crash tomorrow. Timing is impossible. Markets can stay irrational longer than you can stay solvent. Anyone who tells you they know exactly when the crash is coming is lying to you. I'm also not telling you to sell everything and hide in a bunker. That's not a strategy. That's panic. What I am telling you is that the conditions which preceded every major crash in the last 100 years are present right now. All 5 stages are either active or imminent. This is not normal. This is not a drill. The question isn't whether you believe me. The question is what you're going to do with this information. Roger Babson didn't just predict the 1929 crash. He prepared for it. While everyone else was leveraged to the hilt, he held cash. While everyone else bought stocks at the top, he bought farmland and hard assets. When the crash came, he was positioned to survive and thrive. Irving Fisher, the genius economist who mocked Babson, lost everything: his fortune, his reputation, his legacy. He spent the rest of his life trying to recover and never did. The difference between them wasn't intelligence. Fisher was probably smarter. The difference was that Babson paid attention to the signals. He respected the pattern. He positioned himself for what was coming instead of what he wished would happen. You have the same choice right now. You can look at the data I just showed you and decide it doesn't apply to you. You can say, markets always recover eventually, right? Or this time could be different. Or you can ask yourself some uncomfortable questions. How much of your wealth is in the stock market right now? Not just your brokerage account, your retirement accounts, your pension, if you have one, your home equity, if you live in a bubble market. How much of that is concentrated in a handful of mega cap tech stocks? How much of your financial security depends on prices staying where they are or going higher? If the market dropped 50% over the next 18 months, which is exactly what happened in 2008, would you be okay? Would you lose your retirement? Would you have to delay your plans by a decade? I'm not telling you what to do. I'm not a financial advisor. I'm a historian, and I study patterns. And the pattern is clear. The people who get destroyed in crashes aren't stupid. They're just unprepared. They trust the experts who tell them everything is fine. They believe the system is more stable than it actually is. They assume someone would warn them if something was really wrong. Nobody warned them in 1929. Nobody warned them in 2008. And nobody is going to warn you now. The warning is the pattern itself. And now you know it. What you do next is up to you. If this helped you see something you didn't see before, subscribe and turn on notifications. I'm going to be breaking down each of these 5 stages in more detail over the coming weeks, including the specific data points you can track yourself. Knowledge isn't power. Applied knowledge is power. The crash of 1929 didn't have to destroy so many lives. The signals were there. The pattern was there. People chose not to see it. Don't make the same choice.